Tony, private market investing or alternatives used to be the domain of college endowments or family offices, but now it's the rage on Wall Street. So first of all, how do you define private market investing?
I think broadly we would define it private equity, private credit, private real estate, and infrastructure. And then, of course, private equity could be divided into venture capital, growth, and buyout. Private credit could include things like direct lending, asset-backed finance, and then real estate debt, another sort of way of getting exposure. But it's a growing space, as you point out.
And in 2022, we saw both stocks and bonds fall, and a lot of people streamed in to alternatives or private market assets. And it really changed a lot of portfolios. And in the book, you talk about that. So what should an asset allocation look like right now that includes private market assets?
Yeah, so I think you're right. 2022, somewhat of an inflection point as the 60 and the 40 were both down double digits, right? The correlation didn't work for us. So I think the appeal of private markets have certainly picked up from that point in time. We'd argue they've always had a role in the portfolio. Today, the industry allocation to alternatives broadly roughly 5%. We think it should be closer to 15 to 20%. It's really changed the outcome of client portfolios. Not the same allocation for all clients, but broadly, somewhere in that area, I think you start to see a real change.
And there's lots of private market assets out there. There's real estate, there's Bitcoin. So which are the best ones right now?
Yeah, so I would say that broadly our long-term view is we think secondaries look really attractive here. Secondaries private equity, kind of an interesting way of playing some of the disruption happening in the private equity ecosystem. In the private credit space, we really like real estate debt. We think that looks really attractive here. And as much as it may seem like an unpopular sort of decision, we actually think real estate looks attractive with the valuations coming down quite a bit over the last couple of years.
And there's lots of vehicles to invest in alternatives. There's Evergreen funds. You can invest in BDCs. What's the best way for investors to get their share of alternatives?
Yeah, so I'd say broadly, as we started this discussion, the first generation available to institutions and family offices were drawdown funds. They were only available to qualified purchasers, very high minimums, very illiquid in nature. What's really exciting is these evergreen structures. And we're happy with the evergreen structure. We don't necessarily make a call that interval is better than tender offer. But what we like about it is they're generally available to investors at lower minimums. You don't have the accreditation standards that you had before. Lower minimums mean broader diversification. They have more flexible features. And we think that's a good place to think about getting the exposure. We're not sure you have to push the envelope too much farther than that.
And you mentioned liquidity. Can you talk a little bit more about liquidity and cost? Because the big rush not too long ago was for passive ETFs, which cost very little, and you don't really have to worry about them in terms of, they just track indexes. So why do I want to get away from cheap passive vehicles and get into something like this, which has less liquidity and is more costly?
So on liquidity, let's be honest, liquidity is something that we've somehow conditioned advisors to think you need to be 100% liquid. I'm not sure why. It doesn't really make sense. If you want to capture the long-term illiquidity premium, that excess return you get for allocating capital private markets, you need to think of them as a long-term investment. So to me, there's a trade-off there. Do I want the excess return? Therefore, I'm willing to do it. With respect to fees, I'm not sure in the private markets you want to be the low-cost provider. You get what you pay for, and unfortunately, you don't get what you don't pay for. So to me, I want the best manager and the best vehicle, and I'm willing to pay a little extra for it because I know I'm handsomely rewarded in the long run.
And then finally, what inning are we in? Have we gone overboard already? Because lots of people are offering alternatives right now. Have we hit a point where it's gone too far? Because Wall Street has done that on occasion.
It has. I'd argue we're still in the early innings. This is still in the infancy. I think what's really exciting to me is not just that you're getting products that are coming to the market. It's the quality of the managers bringing products. Institutional managers who never wanted to be in the wealth channel are now bringing products to the market. That's a really good thing for all of us. At the end of the day, the advisor wins, the investor wins. We all win if we can bring really good products. To your point, you don't want to water them down. You don't want to go too far on it. So I'm very happy with where we are, but I'd argue it's still the early innings.
All right. Well, congratulations on the book, and thanks for coming.
Thanks so much.